Your 401k looks fine right now. The number is green, maybe it even went up this month. You're not panicking, you're not behind on anything, you're doing the responsible thing. And somewhere inside the Federal Reserve, in a press release that got approximately zero coverage on network news, something just happened that affects every dollar you have ever saved. They didn't call it money printing. They called it reserve management purchases. Same mechanism, different press release. And in the next few minutes, I'm going to show you exactly what that means, why central banks around the world have been quietly buying gold at a record pace for 3 consecutive years, and why the move that just happened inside the Fed is the signal that the people who understood this earliest have been waiting for. This is not a prediction. This is a sequence of documented events, and once you see the sequence, you will never look at your portfolio the same way again. Let me tell you what just happened. In December of last year, the Federal Reserve quietly announced it would begin purchasing $40 billion in Treasury bills every single month. No major press conference, no primetime coverage, no breaking news alert on your phone, just a line item in a policy document called Reserve Management Purchases. Here is what that term means in plain English. The Federal Reserve creates new money out of thin air and uses it to buy government debt. That is the literal definition of money printing. The words reserve management in front of it do not change the mechanics, they only change what it sounds like on a press release. Now here's why this is genuinely unprecedented. The Fed spent 3 years from 2022 to 2025 telling the American public, the bond markets, and the global financial system that it was doing the exact opposite, fighting inflation, tightening its belt, reducing its balance sheet. It was the most aggressive rate hiking cycle in 40 years. And now, quietly, without the fanfare, it has started going in the other direction. Not because inflation is defeated, not because the economy is in great shape, but because the math of the US debt situation has left it with essentially no other option. And here is the math. $36 trillion in current national debt. $1 trillion in annual interest payments alone. That's more than the entire defense budget, just to service the debt. Between $9 and $12 trillion in federal debt is maturing and needs to be refinanced this year. And on top of all that, the Fed itself has lost $245 billion since 2022. Think about that. A central bank that can print its own money is losing hundreds of billions of dollars. How is that possible? Because after 2008, the Fed started paying commercial banks 4% interest on reserves they parked at the Fed. But the bonds the Fed bought during the pandemic only pay 1 or 2%. The Fed is paying out far more than it's earning, on a scale no private company could ever survive. They called the resulting loss a deferred asset, which is, and I want to be precise here, one of the most creative pieces of accounting in the history of modern finance. Translation, we are technically insolvent, but we write the rules, so we're calling it fine. And right after that, they started the reserve management purchases, $40 billion per month, creating money to buy debt to keep the entire system liquid. That is what the Fed just did. Now, let me show you why central banks around the world started buying gold at a record pace and why it started in exactly February 2022, because this is the moment that changed the calculus of every sovereign wealth fund and treasury department on the planet. The United States froze Russia's foreign currency reserves, $300 billion in assets that a sovereign nation held in Western financial institutions, frozen overnight by a government decision. No court order, no international tribunal, one executive decision. And behind closed doors in the treasury departments of every country that is not a firm American ally, the same thought occurred simultaneously. If they can do it to Russia, they can do it to us. The dollar is not a neutral reserve asset, it is a geopolitical instrument. And the only reserve asset that exists entirely outside that system, the only thing that cannot be frozen by executive order, blocked by financial sanction, or seized by a government decision, is physical gold. That is when phase 1 of the current gold bull market began. Central banks bought over 1,000 tons of gold per year for 3 consecutive years. That's approximately double the historical average. This wasn't retail investors, not momentum traders, not social media influencers. This was sovereign nations, systematically, quietly, replacing dollar-denominated assets with physical gold. And here's what most people watching the gold price right now are completely missing. Phase 1 is the quiet, institutional phase. It is central banks walking calmly toward the exit before the fire alarm goes off. From the outside, it just looks like gold keeps going up for reasons that are hard to pin down. That is exactly what Phase 1 is supposed to look like. The absence of a visible crisis is not evidence that a crisis isn't forming. It is evidence that you are watching it in its earliest stage, the stage where positioning still happens at reasonable prices. The Fed's reserve management purchases are the first visible signal that Phase 2 is beginning. Let me give you a framework to make this all navigable. 3 phases. Phase 1, the quiet repositioning. This is central banks buying, sovereign wealth funds reallocating, the smart money moving before the story becomes consensus. No bank failures, no bond market crisis, no emergency Fed meetings, just gold quietly going up for reasons most people dismiss. We have been in Phase 1 since 2022. We are still in it, but the Fed's recent move is the first signal that Phase 2 is forming. Phase 2 is the market realization. This is where things get genuinely significant. Phase 2 begins when the market realizes that the Federal Reserve is not choosing to print money, it is being forced to. And that distinction between choosing and being forced is everything. A central bank that chooses to print money retains credibility. A central bank that is forced to print money because the alternative is a systemic collapse of the bond market has lost its most important asset, the belief that it is in control. The new nominee for Fed chair stated publicly he wants 2 things: lower interest rates and a smaller Fed balance sheet. Both sound responsible. Both are mathematically contradictory given the current debt situation. You cannot shrink the balance sheet while keeping rates low when you have $10 to $12 trillion in bonds needing to be refinanced in the next 12 months. If the Fed steps back from buying Treasury bonds, who buys all that new debt? Foreign central banks are already buying less. The bid for Treasury bonds is thinner than it has been in decades. So the choice the new Fed chair will face is not between his principles and money printing, it is between money printing and allowing the bond market to break. And every Fed chair in history, without a single exception, has chosen money printing. Jerome Powell was openly skeptical of quantitative easing in 2012. In 2020, he printed more money than any human being in the history of currency. The pattern repeats because the alternative is always worse. Phase 2 is when the market stops believing the stated principles and starts pricing in the forced reality. That is when gold moves from expensive to something people say they cannot afford not to own. Now let me add the layer that could compress this multi-year story into a much faster one: oil shocks. The relationship between major oil disruptions and gold prices is not occasional. It is one of the most consistent patterns in 50 years of market history. 1973, the OPEC embargo. Oil quadruples. Gold surges 89% in the following 12 months. 1979, the Iranian Revolution. Oil up 110%. Gold climbs nearly 150%. 1991, the Gulf War. Oil spikes sharply. Gold moves 15 to 20% almost immediately. Every major oil shock, every single time. Why? Because oil shocks do 2 things at once. They embed inflation into the economy in a way that's very hard to reverse, and they simultaneously raise the probability that central banks cannot raise rates aggressively enough to fight that inflation, because the same energy shock also slows economic growth. Embedded inflation plus a monetary authority that cannot fully respond. That is the precise environment where gold performs most traumatically. Not because gold is a simple inflation hedge, because gold is a hedge against monetary systems that are losing their credibility. Right now, the Strait of Hormuz, through which 20% of the world's daily oil supply flows, has been commercially disrupted. Oil tankers struck, more than 100 vessels halted. Goldman Sachs has calculated an $18 per barrel geopolitical risk premium already in current prices. Wood Mackenzie is projecting $100 oil if the disruption continues for weeks. The oil accelerant is active, the monetary backdrop from the Fed is in place, the structural repositioning from 3 years of central bank gold buying is the foundation. These are not 3 separate stories, they are 3 layers of the same story converging right now. Here's the anomaly in the current gold market that almost nobody is talking about clearly. Gold mining stocks are at record profitability. When gold was at $2,000 an ounce, a miner with $900 production costs was making an $1,100 margin. Today, with gold at current prices, that same miner might be making $1,500 or more per ounce. Gold goes up 50%, the miner's margin doesn't go up 50%, it goes up significantly more. That is the leverage embedded in gold mining stocks. And yet, money is leaving gold mining ETFs, not flowing in. The major gold miner ETF has seen 20% of its shares redeemed. The junior mining ETF, nearly 22% of its shares gone. The broader public, the retail investor, the crowd that drives the final phases of any major bull market, has